If you're new to dividend investing and want to know a little bit more, you want to know some tips, I found a awesome article that has 5 tips on dividend investing. And I'll also gonna give my commentary, so let's get started. So this article is called 5 Dividend Investing Tips That Could Earn You Thousands. If you're in the market for dividend paying stocks for your portfolio, you're making a smart move, and I, of course, agree. The power of dividends is often underappreciated, and that can be a costly mistake. So, most investors, especially investors that are just starting out, they only think about capital gains. So, buying low and selling high, usually in the form of growth stocks also. People don't usually think about the long-term approach of investing. So investing in dividend-paying companies, and of course in the beginning you will not see a big return in the form of dividends, but if you stick with the strategy, you will be able to snowball your income or pretty much snowball your wealth. The power of dividends is often underappreciated and that can be a costly mistake. Consider this: from 1930 to 2019, dividend income's contribution to the total return of the S&P 500 index averaged 42%. So what this is actually saying is that when you look at the S&P 500 and look at the S&P 500 performance on the stock market, over 50% of the gains came from capital gains. So that's the appreciation of the underlying companies in the S&P 500. However, 42% of that appreciation came from dividends. So dividends being paid out and then also reinvested back in that index. Imagine that you have a portfolio valued at 300,000 with an overall average dividend yield of 4%. That will kick out 12,000 to you annually, offering an average 1,000 of monthly income that will be very welcome in retirement. Now, 12,000 the first year, pretty good, but keep this in mind. A lot of the companies on the S&P 500 that pay a dividend, they also increase their dividend payment every single year. So the first year it might be 12,000, but the next year it might be 4% higher. And then also, if you reinvest those dividends, you will be able to get a lot more than just 12,000 the next year. Or can be reinvested in additional shares of stock to keep your portfolio growing. Don't just jump into dividends without learning a little bit about them first though. That's why you can follow my channel. Just hit subscribe, check out my dividend playlist for beginners. Here are 5 useful tips to know. Bigger isn't better. Beginner investors may want to grab the fattest dividend yield they can find, and there are often at least a few companies with yields topping 10%. Now, one thing that I've said in the past is that if a company has a very high dividend yield, it could potentially mean that the price of the stock dropped to a very low number. So, like I gave this example earlier. If a company, if the price of a stock is $100 and the dividend that it pays out is $1, that's a 1% dividend yield. Now, let's say the price of the stock, oh, I just got a like on Tinder, awesome. If the price of the stock dropped all the way down to 10 bucks, now the dividend is still $1. The dividend yield now is 10%. So that's something concerning to me. You want to double check and do some research on why that dividend yield is so high, in this case 10%. It may seem hard to pass up such a hefty payout, but frequently it will be the right thing to do because very big yields can be a sign of companies in trouble. Yes, definitely. And one thing to keep in mind also is that some companies pay a low dividend yield but have a high dividend growth, and other companies pay a high dividend yield or a high dividend but have a low dividend growth rate. A company that has a low dividend growth rate and a high dividend yield is AT&T. Another one that comes to mind is Verizon. Remember the math. A dividend yield is simply a company's annual dividend payment divided by its current stock price. So a $40 stock paying a $2 annual dividend, typically $50 per quarter, has a yield of 5%. 5% is on the high side, but there are a lot of good companies that have currently a 5% yield. I just bought a couple of shares in AppFi, which has a 5 to 6% dividend yield. But if the company falls on hard times and its stock price falls to $20, the yield will shoot up to 10%. $2 dividend, $2 divided dividend by 20. If the hard times persist, the company may well reduce, suspend, or eliminate its payout, as many companies have done. Blah, 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 blah. Now, number 2, favor fast-growing dividends. Next, don't make the mistake of assuming that a 4% dividend yield is better than a 3% one. A dividend's growth rate is very important. Some companies increase their payouts only a little every year or two, while others in the midst of robust annual increases. Over several years, a 3% yield can become an effective yield of 5 or 6% or more. If you're invested for a long time in a healthy and growing dividend payers that are increasing their dividend payouts at a good clip, you can expect to collect more and more from them each year. So I don't feel like they explained number 2 very well. But like I said, there are companies that pay a low dividend yield but have a high growth. And then there are also companies that pay a high dividend yield but they have a low dividend growth rate. Number 3, check the payout ratio. So the payout ratio pretty much tells you how much net income is paid out as a dividend to the shareholders. It's also useful to examine the payout ratio of any dividend payer you're considering. The payout ratio is calculated by dividing the annual dividend amount by the annual earnings per share or net income. Imagine, for example, Busy Broccoli Beer, funny name, which pays a quarterly dividend of $1 and sports an EPS of $8. To get the payout ratio, you divide the total dividend of $4 by the EPS of $8, which is a 50% payout ratio. That reveals that Buzzy is paying 50% of its earnings in dividends, and the 50% ratio is pretty good because it suggests that the company shouldn't have too much trouble maintaining its dividend, and better still, that the dividend has room to grow. One thing that I like to look at when I look at the payout ratio is consistency. So year after year, and I like to look at the last 10 years, I want to make sure that the payout ratio has been consistent. So if Buzzy Broccoli Beer has a 50% payout ratio this year, I want to see what the payout ratio was the previous years. Was it 50% also? Was it higher or was it lower? If it was lower and I'm seeing it trending up to 50, that's a little bit concerning. 50% is still good because the company can still pay out a dividend without getting in trouble. But if I see a trend going up, that's something that I pay attention to. Payout ratios that approach or exceed 100% are not ideal. If a company exceeds 100% of their payout ratio and they consistently exceed that, that pretty much means that a company is paying the dividend out of their debt pretty much. Still, every company and its situation are different. Dig into any company you're considering to get more details. Perhaps its EPS was simply low this year because of some special circumstances. Or maybe it's growing its earnings so briskly that it should be able to cover its payouts. Number 4, seek high-quality dividend payers and buy them at a good price. So that's a good tip. What I like to do is I pay attention to the PE ratio. So whenever I'm ready to buy a company that I have on my watch list, the first thing that I do is look at the PE ratio. I like to see a PE ratio of 20 or less, and then I always say 15 or less is even better. Next, be sure that any dividend paying company you invest in is a high quality one. High quality to me means that a company can pay a healthy dividend because they're always growing their net income. Ideally, with little to no debt and plenty of cash, with growing revenue and earnings and profit margins, and a sustainable competitive advantage. I wholeheartedly agree with all of those. Only thing I would add is to also look at the return on equity. Make sure it's in the double digits. Same thing with the ROIC. You also want to buy into any company at a good price. Buying into a terrific company when it's grossly overvalued can result in your shares losing value as they fall closer to the intrinsic value. So they don't talk about how you can pretty much evaluate if a company is selling at a discount or not. So the PE ratio is not the be all end all, but the PE ratio is a good way to look at if a company is overvalued or not, and then compare the company's PE ratio to others competitors in the market, see what their PE ratio is. That will give you a good indication of if the company is expensive or selling at a discount. Reinvest those dividends. So when it comes to reinvesting dividends, there's two approaches to this. You can either reinvest the dividends into buying more fractional shares of the same company that spit out the dividend to you, or you can take that dividend and invest it in other dividend paying companies. To me, it's better to take the dividend and invest it into other dividend paying companies than to reinvest it into the same ones, because you might be reinvesting it in a company that is selling when it's expensive and not selling at a discount. So let's see what they say. Finally, once you're happily invested in some solid companies, collecting meaningful payouts every quarter, reinvest those dividends if you can. Doing so can really turbocharge your portfolio's performance because that dividend money can add many more shares to your collection. Whether you're adding shares of companies you already own or shares of companies new to your portfolio. So let's revisit the earlier hypothetical 300,000 portfolio with an overall 4% yield. It will deposit about 12,000 in cash dividends into your account. And it's up to you what to do with that money. If you reinvest it and it grows at an annual average of 8%, it will be worth about 56,000 in 20 years. And he's talking about the dividend income. Remember that in the following year, you'll likely collect another 12,000 or very possibly more, perhaps 13,000. You can see how this is an effective way to build wealth. And the cool thing about investing in dividend companies with this strategy is that while you're building your wealth, you will never have to sell potentially those underlying companies, those investments. I only sell them when these companies either cut their dividend or they cancel their dividend. I had to do that with Disney because they canceled their dividend. So go ahead and seek some great dividend stocks for your portfolio. Just keep the guidelines above in mind. And that's the end of the article. The article doesn't go into where you can find some of those dividend paying companies, but I would say, and I actually did a video on this, so just check out my video. I'll probably link it to how you can find good dividend paying companies. But pretty much use David Fish's Excel sheet, use stock screeners, or use like everyday products that you use on a daily basis. See if those products, the companies of those underlying products, see if they give out dividends to their shareholders. So if you're familiar with a product like Nike because you buy the Nike shoes, just go to the Nike website. You'll see that they actually do pay out a dividend to their shareholders, and that's a good company to invest in. So pretty good article. Could have been a little bit more fleshed out, but I liked it. Let me know if you like this article also, and I'll talk to you guys in the next one.